Welcome back. Wells Fargo shares are on the move today, down more than 2%. That's after two competing analyst calls on the street. Deutsche Bank downgrades to a hold, while Raymond James upgrades to a market perform. That's after former CEO Tim Sloan announced his retirement yesterday. We've made it our call of the day. Competing calls, which is why we bring it to our own investment committee to decide it. Jim Lebenthal. So one firm goes the downgrade. They worry about risks. The new CEO, new business model potentially, or any changes to the business model are a negative. The positive is the upgrade from a sell, and that's at Raymond James, and that's the Sloan retirement just removes a headwind. So which is it?
I think it's a pretty simple call that you don't own this stock. I mean, first off, let's start with the financial sector has just been horrible for a year and a half now. So if you want to be in this space, why not be either in the high quality like a JP Morgan or be in one of the cheaper names, at least on a price to book value, like a Bank of America or Citigroup. In this name, you don't have quality. You've got something that has tremendous regulatory. They're still in the penalty box with the Fed, by the way. Elizabeth Warren probably has a picture of this, on her office wall with a dartboard over it. And it's not cheap. It's almost comparable to JP Morgan. It doesn't make any sense to buy the stock to me.
So, Ron, more broadly, banks, do they work in the environment we're in where yields and falling rates are the headline every day?
Well, and I think it depends which kind of bank you're talking about. I mean, investment banks would have trading opportunities.
Big money center banks,
look, there's still, and I don't typically look at banks this way, but with the yield curve inverted, the spread business is much more difficult to operate. And we're also later in this cycle with respect to credit standards and such. So there's probably more risk on the downside, even though they're not performing that well. You would need, I would say, some identifiable catalyst for banks to move higher. And if people want to talk about a steepening yield curve, that also means the Fed potentially reversing course and talking about raising rates. So
Quarles follows through on what he wants to do.
I think that he might have just been offsetting Stephen Moore's comments, who may be an incoming Fed governor, who said that the Fed should lower rates by 50 basis points. So certainly that Mr. Moore got way out in front of his skis making a suggestion like that for an immediate rate cut. So maybe they're just trying to alter expectations in that regard.
Josh, your view on the banks in the quarter ahead?
I own JP Morgan, and I agree with what Jim said. If you tell me Wells Fargo is selling at a 10 or 15% discount to the group on book value, and it's got a yield appreciably above a 30-year treasury, I'll say, all right, I'll stick around. I'll see if this company can fix itself. But that's not the case. Yield's not high enough. Buyback is not big enough. And discount is non-existent. So why does the stock not have a discount? Maybe because Berkshire Hathaway owns almost all of the float, and everyone knows it's not ever going to really get appreciably much cheaper unless he sells. And he keeps telling people he's not going to. So I don't think a big enough opportunity has been created here to get excited.